In 2008, millions of people lost their homes. Banks collapsed, jobs disappeared, entire life savings gone in months. And yet, just a few years later, something strange happened. The people at the very top, the ones closest to the financial system, came out richer than before. Not just recovered, wealthier. Then it happened again. In 2020, the world shut down. Businesses closed overnight. Entire industries froze. Fear spread faster than any virus. And once again, the same pattern. Markets crashed, then they surged. Assets exploded in value, and the gap between those who had capital and those who didn't widened dramatically. So here's the uncomfortable question. Why do economic crises, events that hurt almost everyone, consistently end up benefiting the same small group of people? Is it luck? Or is something deeper going on? Because once you see the pattern, it's hard to unsee it. Let's start with what most people think a crisis is. A crisis feels like chaos, unpredictable, random, out of control. Markets panic, prices collapse, governments scramble, headlines scream. It looks like the system is breaking, but underneath that chaos, the system is actually doing something very specific. It's redistributing. Not evenly, not fairly, but predictably. From the outside, a crash looks like destruction. From the inside, it looks more like a transfer. And to understand that transfer, you have to follow three things: money, assets, and timing. First, money. When a crisis hits, liquidity disappears. That's a technical way of saying cash becomes king. People lose income, businesses struggle to pay bills, credit tightens, loans become harder to get. Suddenly, everyone needs cash at the same time. But there's a problem. Most people don't have much of it. Their wealth is tied up in salaries, small savings, or assets that are now falling in value. So when pressure hits, they're forced into decisions. They sell investments at a loss. They liquidate assets. They take on expensive debt just to survive. This isn't about bad decisions, it's about timing. Because at the exact same moment that most people are desperate for cash, a small group has access to almost unlimited liquidity. Large institutions, major investors, central banks, governments. They don't just have money, they can create it, borrow it cheaply, or move it instantly. And that difference, access to liquidity during a crisis, is where the game begins to tilt. Now let's talk about assets, because crises don't just destroy value, they reprice it. When panic hits, asset prices fall, stocks drop, real estate stalls, businesses lose valuation. But here's the key detail. The drop isn't always tied to long-term value, it's tied to short-term fear. Imagine a solid company, profitable, stable, strong fundamentals. During a crisis, its stock might drop 30%, 40%, even 50%. Not because the company suddenly became worthless, but because people need cash now. They sell what they can, fast, and that selling pressure pushes prices down, sometimes far below what the asset is actually worth over time. So while millions are selling under pressure, someone else is buying, quietly, patiently, aggressively. Because if you have liquidity during a crisis, falling prices aren't a threat, they're an opportunity. This is where timing becomes everything. Crises compress time. They take slow economic shifts and force them to happen all at once. What would normally take years, market corrections, bankruptcies, consolidation, happens in months, and that creates a rare window. A window where assets are discounted, competition is weakened, and entire sectors can be reshaped. But here's the catch. You can only take advantage of that window if you're not the one being crushed by it. If you're trying to survive, you can't think long-term. If you're trying to invest, you need stability. And stability is exactly what most people lose during a crisis. So now we have the basic structure. Most people lose liquidity and are forced to sell. A small group has liquidity and is able to buy. Prices drop not always because of value, but because of pressure. That alone explains part of the pattern, but it doesn't explain why the same people keep benefiting. For that, we need to go one layer deeper. Because crises don't just affect markets, they trigger responses. And those responses matter more than the crisis itself. When things start to break, governments and central banks step in. They lower interest rates, They inject money into the system. They create stimulus programs. On the surface, this looks like support for everyone, and in some ways, it is. But the way that money enters the system is not neutral. It flows through specific channels, usually financial institutions first, then corporations, then, eventually, the broader public. And by the time it reaches everyone else, the system has already moved. Asset prices have already started rising again. Stocks recover, real estate rebounds, markets stabilize. So if you owned assets before or during the recovery, you benefit. If you didn't, you're playing catch-up. This creates a strange effect. The same policies designed to stabilize the economy also accelerate inequality because they inflate asset prices faster than they restore incomes. And assets are not evenly distributed. A small percentage of people own the majority of stocks, real estate, and financial instruments. So when prices surge, their wealth surges. There's another layer to this, and it's less obvious but just as important. Crises eliminate competition. Small businesses close. Weaker companies go bankrupt. New entrants struggle to survive. Meanwhile, larger players, those with capital reserves, credit access, and scale, can endure the storm or even expand during it. They acquire struggling competitors. They capture more market share. They consolidate power. So when the crisis ends, the landscape is different. Less competition, more concentration, and more pricing power in the hands of fewer players. This is why some of the biggest companies in the world didn't just survive recent crises, they dominated them. While small businesses shut down, large platforms grew faster than ever. While local economies struggled, global corporations expanded their reach. And once that shift happens, it's hard to reverse, because power, once concentrated, tends to stay that way. At this point, it's tempting to think this is all intentional, that crises are designed to benefit certain groups. But the reality is more complicated. It's not necessarily about a coordinated plan. It's about structure. The system is built in a way where access to liquidity is unequal. Ownership of assets is concentrated. Policy responses favor stability over fairness, and timing determines outcomes more than effort. So when a crisis hits, the results aren't random, they're predictable. And here's where the irony kicks in. The very things that make the system stable in normal times are the same things that amplify inequality during crises. Low interest rates encourage borrowing and growth, but they also inflate asset prices. Financial markets create efficiency and liquidity, but they also centralize wealth. Globalization increases productivity, but it also concentrates power in large institutions. So when stress hits the system, those same mechanisms don't disappear, they accelerate. And now contrast this with the story most people hear, that crises are great equalizers, that everyone suffers equally, that markets reset and give everyone a fresh start. It sounds fair, it sounds comforting, but it's not what the data shows, because recovery is not symmetrical. Some people bounce back faster, some never recover, and some leap forward. Think about what happens after every major crisis. Asset prices eventually reach new highs. Corporate profits recover. Markets stabilize. But wages? They lag. Savings? Often depleted. Opportunities? More limited for those who lost ground. So the system resets, but not evenly. And this brings us to a more uncomfortable idea. Maybe crises don't just reveal inequality, maybe they reinforce it. Because every cycle creates a feedback loop. Those who gain more assets during a crisis have more leverage in the next one. More liquidity, more influence, more resilience. So when the next shock hits, they're even better positioned, and the cycle repeats. This doesn't mean individuals are powerless, but it does mean the playing field isn't flat, because understanding the system doesn't change the system. It just changes how you see it. So the next time markets crash and headlines talk about panic and uncertainty, it's worth asking a different question. Not just what is being lost, but what is being transferred. Because behind every crisis, there's a shift happening, quiet, structural, relentless. And the people who benefit from it usually aren't reacting in fear, they're acting in timing. Which leads to a final question. If crises keep rewarding the same behaviors, the same access, the same positioning, then are they really unpredictable events? Or are they moments where the system reveals exactly how it's designed to work? And if that's true, the real question isn't who gets hurt next, it's who will be ready when it happens again.